Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's the end of April 2025, and there are huge worries for the American economy and the world economy about the Trump presidency and what will happen in coming months and quarters as the rather erratic policies of the current American administration play out. Now, I'm going to be concentrating on that. I will do a kind of a global tour d'horizon of the money developments around the world, but the focus will be on Trump. The last few weeks have seen announcements of huge tariff increases, the postponement of these tariff increases, the cancellation of these tariff increases, the reimposition of these tariffs, a huge amount of uncertainty. And a number of authorities are then saying that this uncertainty will cause a recession. Now, I did at the start of this year have a look at global money trends. This is really before all of the policy changes associated with Trump, before it had really been announced. And I did say that 2025 would be a challenging year with more likely to be beneath trend growth of world demand and output than above trend growth. And I also said this would be helpful for inflation. Now, obviously, there are things that have happened since then. And let me first of all just recognize that these tariff increases are being compared with the so-called Smoot-Hawley Tariff Act of 1930. These were imposed early on in the American Great Depression, in theory, to defend American jobs. Shortly afterwards, in fact, unemployment went up to 9%, and then within 2 years to 23%. So the results weren't quite what they were supposed to be. But it may be that we need to look at this comment here by a chap called Jeremy Adelman, Cambridge. Smoot-Hawley has become a watchword for economic idiocy. Are we repeating century-old errors, nudging a crisis into a collapse? I'm going to argue this is a bit overdone, but let's just first of all think about how protectionism might cause a recession. Because normally in economic theory, you don't connect trade theory and demand, the business cycle, output, employment. You don't do that. That's not standard theory at all. But there clearly are some connections. I mean, plainly, if tariffs are imposed on imports from China, then those people involved in carrying the imports from China around America by train and by lorry and so on, they'll lose their jobs. That's obvious. But in general, there'll be some offsetting positive effects too. In other words, there'll be those people who are required to produce things that had been imported from China. There'll be demand. These kind of direct effects aren't terribly clear. It's the indirect effects through, first of all, uncertainty, which there's more uncertainty, there's less investment. If you're a Keynesian and believe that national income is a multiple of investment, then you're obviously going to get a recession from that kind of effect. There's also a very important aspect of all this, which is that parts of investment are actually into the traded sector. Most obviously, in the case of world trade, it requires planes and ships. So if there's to be less trade, we need fewer planes and ships. And in the 1930s, this is very important for Britain, which then led the world in shipbuilding. So there was a catastrophic collapse in demand for ships, new ships, and shipbuilding practically had a wipeout. And there was nothing that monetary policy could do about that. Same kind of thing today. There's going to be a reduction in if this all carries on, a reduction in the demand for planes to carry freight, obviously. A kind of monetarist argument is that the downturn in business confidence, which is very clear, will cause less borrowing from the banks. Less borrowing from the banks means slower money growth. Slower money growth means a weaker economy, etc. So there's an assortment of arguments of this kind. Now, first of all, just say here that so far, if there is much of this, it's not really happening as yet. We have weekly numbers on jobless claims in the USA. As for the time being, they're resilient. There's nothing very shocking happening here. But we're talking about the next few months and quarters, and indeed, there are plenty of reasons to worry about falling demand and output, partly because of protectionism coming up in the rest of this year and in 2026. But having said all that, the dominant explanation for the Great Depression of the 1930s is not protectionism, it's not Smoot-Hawley. The dominant explanation is that the banking system imploded, in the USA in particular, and the quantity of money fell by about 40%. You can see here this chart that it's of money growth and the growth of normal GDP in the USA in the interwar period. There's a collapse in broad money just after the First World War, recession, recovery in money growth, then the very strong 2020s. And then we had the implosion of the banking system in the early 30s, collapse in money growth, and you can see the Great Depression there in the number for normal GDP. And so if people want to think about 25 and 26, it's these money trends that, in my view, really matter. And so this is a chart that appears in all our monthly research. This is the growth rate of broad money in the USA. I've got both the annual number and the 3-monthly annualized figure. Now, the main feature here, I've spoken endlessly about the surge in 2020 and the subsequent inflation. That's all history now. The money growth then collapsed. Inflation came down. In the last year or two, money growth has been running around about 2, 3, 4% a year, which is about ideal, actually, for the American economy. That's ideal for meeting an inflation target of about 2%, and is really the kind of number which one has to applaud. Having said that, the money growth hasn't really returned back towards 4, 5, 6%, which had been more normal, if you like, in the last 20 or 30 years. And part of the reason is that the American banking system took a big hit to its profits and capital in 2022. In 2022, the Fed raised interest rates very sharply. This was unexpected at the time. It was unexpected because there'd been all of these forecasts of endless deflation, disinflation, interest rates staying out to zero forever, which all these forecasts, which, by the way, I didn't support, I disagreed with them. All these forecasts meant the bond yields are very low, interest rates go up, bond yields go up, bond yields fall, and this then hits banks' profits. And in fact, this hit to banks' profits in 2022 was bigger than in the Great Recession period of 2007 and 2008. This chart here shows you that, in fact, in terms of constant 2022 money, the hit to profits was about twice as large as before the Great Recession. And in terms of the bank's capital to equity ratio, it fell by more than in the run-up to the Great Recession. It hasn't been much noticed, but this was part of the reason for the rather slow growth of money in that period. And indeed, there was a period when, for some quarters, when money growth in the USA was nil. There wasn't any at all. Anyway, there has been a return to money growth. It's not very high. This is a chart I thought in this context is worth highlighting. It shows you the banks, American banks, capital to equity ratio, capital to equity capital to asset ratio. They've got the equity, which is there to buffer them against all their risks. And then there's all the assets, all the loans that are going to be taking every now and again some loan losses. And then roughly speaking, deposits on the other side of the balance sheet are the same size as the assets, so that this taking of risk by the banks and this equity to asset ratio is very important to how the banks behave. You can see at the moment it's quite strong and has in fact been picking up a bit in the very recent past. So there's nothing very much the matter here, more generally speaking. This is not like the 1930s, and I'm going to come and say it again you see, broad money growth, whatever the problems in the American banking system, broad money growth is positive. It's not falling by 0.5%, 1% a month, as it was in the early 1930s. There is obviously a move in the USA to protectionism. It led to disaster. As part of the disasters of the early 30s, this is not the whole story at the moment. Protectionism, yes, but money growth is positive, if rather low. But there's other parts of the world economy you should think about. What about China? Well, this is the chart of money growth in China. You can see it's been falling steadily since the period of hypergrowth in China in the 1990s and the noughties, the first decade of the 21st century. It's come down towards 7%. And the trend growth of real output in China is also lower. It's come down a bit. It's not collapsing. What about the Eurozone? Well, the Eurozone had, as in the USA, a period of money stagnation 2 or 3 years back. Money growth actually has picked up in the recent past, running around about 4 or 5%. Japan, other way, money growth quite buoyant around about the COVID period, fell back. Now really just about 1, 2%, really very, very low. And then finally, India, of the big countries, India has got money growth running at around about double-digit annual rate, and there's considerable continuing expansionism of the dynamism of the real economy. It's true that the banks and broad money are growing slowly in the USA, the Eurozone, UK too, Japan hardly growing at all. Chinese banking system has got some long-term problems to do with the fact that loan collateral against all the buildings, the office blocks, the residential towers and so on that are all over China, the collateral for the loans that the banking system has, it's been overvalued, and that's affecting the banks. India still has rather rapid money growth, and so by the way, there's places in the Middle East and South America and so on. I think my conclusion here is that money growth is positive. Even the USA, where the banking system has had some trouble, it is positive. It's not the 1930s. Trump's protectionism will reduce living standards, will cause a dip in growth, but it also, by the way, will cause an upward blip to the price level, not really continuing inflation, but an upward blip to the price level. The prospect, therefore, for this year and next year is a bit of stagnation, a bit of stagnation with some inflation, a bit of stagflation, not a global slump. This is not the 1930s. And although once there's hardly any visibility about the American political outlook, there is, of course, the midterm congressional elections in November next year. I think a reasonable view is that there'll be a Democrat landslide, and at that point, the Trump administration will be largely neutered. I don't myself believe that the events of early 2025 mean the end of globalization, and this is obviously for debate, but in some ways, the way the world has reacted shows that most politicians, most political leaderships and elites around the world are actually strongly opposed to the kind of thing that Donald Trump stands for. In a way, the real problem in the USA at the moment, I don't deny that protectionism and tariffs are problems, but is the mess in the American public finances. The debt is, in my view, measured correctly about 120% of GDP. The deficit is running at around about 7% of GDP, depending on how you measure it. And the ratio of debt to GDP, unless something is done, is rising inexorably. If financial markets lose confidence in Trump, particularly, for example, if he decides to sack Powell, Jay Powell from the Federal Reserve, decides he's going to want to do it, and he actually does it, then the effect on the interest rates on US government debt will be to raise them. That'll add to the servicing costs of the debt and aggravate the unsustainability that is already there. So what we need to do is to look every month, really, at the figures for the American deficit and compare them with the recent past. That's what I've done in this chart here. The blue line is the annual total up to the latest month in the current fiscal year. US fiscal year runs from October to September. And you can see that that blue line is pretty steadily above the red line that was, for the most part, what was going on in the Biden administration. It doesn't look very good news. However, that blue line does include some final months at the very end of the Biden administration. And if you look, in fact, at the 4 months, December 24 to March 25, which are pure Trump, in fact, they're the same as the corresponding months, 4 months at the end of the Biden presidency, towards the end of the Biden presidency. And so it may be the case that there is really some effect from the cutbacks in spending on this deficit, but it could all be spoilt if interest payments on the debt start to soar because of a destruction of financial confidence. What does one say about Donald Trump? There's a wonderful line in the Lex column in the Financial Times on the 8th of April that he was more Jackson Pollock than Rembrandt. And of course, Jackson Pollock, like Donald Trump, is from New York. And as you'll probably be aware, Jackson Pollock was an artist, a doyen of so-called abstract expressionism, who would put a canvas on a floor and throw paint at it. One has a sense here that Donald Trump is just throwing policies at the world economy without any kind of rhyme or reason, and this certainly wasn't Rembrandt. You can compare one of Jackson Pollock's paintings with a Rembrandt. Well, maybe. What I would say is that even if one wants to say that Trump is to politics what Jackson Pollock was to art, we still look at Jackson Pollock's works of art, and art goes on. And this isn't the end of the world. I mean, it is very troubling that we have a president of this kind. But with financial markets now against him, he is facing increasing constraints on the kind of mess that he wants to create or appears to want to create. Thank you.